thank you very much for having us today to this gathering of You Invest. I'm here to talk a little bit about Aberdeen Investment Trust, but as I was putting together the slides, I thought it'd be more interesting to talk a little bit about you. We've just done some research which looks at the self-directed private investor, and that really means people who actually manage their own portfolios and where they go to get information. And I thought it'd be interesting to play back to you what I think we found from many people like you. I don't know whether any of you know us at Aberdeen Asset Management at all. Do you invest in an Aberdeen Investment Trust? If someone could stick a hand up or do. Oh, great. And do I have a right to? That's another question. I'll explain a little bit about Aberdeen generally. We manage 17 closed-end funds, and I won't drill down to the particularity, but actually very similar to the previous speaker, we like investment trusts because they have certain things which are very different to open-ended funds, which we believe can be an asset during difficult times, particularly with revenue reserves to pay out, build a dividend record that goes well. So without further ado, I will plunge my way into explaining a little bit about us and where we come from. I'm head of brand as well as head of investment trust marketing, and that is quite interesting for me because it gives me a chance to look at all the many asset management groups that come and talk to you, and you realize how dangerously commoditized we're all becoming. Because every asset management group claims to have all the virtues of all the others. We're active investors, we run active, we're concentrated portfolios, we're global, and we're special. And actually, the danger with that too much is that we're talking ourselves into really just becoming an everyman asset management groups, and it's quite important to try to look at differentiation and to see we can be different from other firms. And we're not alone with this. Professional services firms generally all sound exactly the same, and when we were doing some work on our brand, I found myself saying that actually for me, Accenture and Ernst & Young and the consulting firms all sound exactly the same. They all say the same things and their logos are marginally different. And I think in the next 10 or 15 years, with the drive of what's happening with the internet, further transparency that's being pushed through there, it's actually we're going to find increasingly we're going to have to stand to something more than just talking about our top 10 holdings and how we've managed things in the past. And I hope that a little bit today might give an indication of where you, self-directed investors, are able to gather information about things that are interesting for you. And I hope that some of the information, the findings that we've got, will be useful if you're in journeys. This is a group of people on the front of this slide, which I work with. They're all real, and we run pretty much the same sort of investment style for equities all over the globe. About 12 or 13 years ago, our head of equities at Aberdeen, a man called Hugh Young, which most people know, he runs Aberdeen Asset Management Asia, set up a uniform process across the globe of all the equity teams regionally and locally, and we all follow the same format. And actually that's been relatively consistent for 12 years, which has been really helpful for us to build our closed-end fund investment trust business, both here in the US. It's at the heart of what we do at Aberdeen Asset Management because quite a lot of the funds that we either inherited or have launched or whatever it is go back into the sort of folklore of the Scottish belief in investment trust companies as being the winning formula for collectives. And whilst this is being nudged away at the edges by ETFs and other vehicles, an investment trust, good ones, are particularly special and able to get a lot more information about them than others can find elsewhere. This chart talks about Aberdeen Asset Management, just briefly, partly because we've grown rather quickly in the last decade or so. The business has acquired a number of other asset management groups along the way, including acquiring a few investment trust contracts, some of which are still reflected historically in the names of the trusts that we manage. So if you've got Murray Income or Murray International in your portfolio, that's a reflection of the prefix of those names for Murray Johnston, which was the closed-end business that we bought in Glasgow about around a decade ago. And the board, of course, are independent of us, so they want to keep, to some extent, their own identity. It talks a bit to the heritage of the business, but we're now a lot larger than we were before, but we're very committed to our equities business because it's such a vital part of the essence of the DNA of what Aberdeen does well. And forgive me, one of these blobs is talking about our assets under management in dollars, and that's because I didn't change the chart when I came back from New York last week. But the sterling bit at the bottom is about our investment trust range. It's about $6 billion. We're number 2 or number 3, depending on whether JP Morgan, Henderson, or ourselves are the top of the pecking order in terms of the most visible brand. And I think it helps in investment trust business, particularly nowadays, to have a fantastic infrastructure behind us to communicate with shareholders, because increasingly there's a demand for personalized content and information, reporting, monthly information, and even at our extent, we get a pipe daily from Morningstar, which gives you all the Greeks or the analytics, whatever it was on that very day and purpose. And I think that's only going to increase as people desire faster and faster information. Doesn't mean they should invest, actually, on a tactical daily basis. In many ways, we're building ourselves into a wonderful state of neurosis. And if we're going back to Benjamin Graham, and we're talking about long-term investing, so just ignore the noise. Unless you need the money this year or this week, whatever it is, just try to be purposeful about, mindful about where you're holding your investments, because that's certainly how our equity fund managers look at what they're holding. Very strong belief in fundamental investing and in owning stock because actually these are good businesses, and not just because they're going to be cheap today. We started off in Aberdeen in Scotland. This is Scotland's third city. I think that's Robert the Duke, Bruce waving a sword. He was doing that, and of course we had Alex Salmon doing that earlier this year. And it looks like that Nicola Sturgeon is going to be doing the same thing in a few days' time. However, we are a global business, and when interrogated too adroitly about what we're going to do about the future of our business at Aberdeen, we're in 25 or 26 countries, one small bit of which, of course, is where our head office is, but at the moment is actually asset management's a pretty mobile business. And quite a lot of our heritage around what we're good at is actually based on investing internationally. And emerging markets, global equities, and Asia Pacific are the strong calling cards of the Aberdeen Asset Management equity process. And we still feel very strongly in those asset classes, even though we've had a sort of recessionary condition for fundamental investing over the last 3 years. And eventually mean reversion will come back. The mad craziness of what central banks appear to be doing to disrupt our risk assets will actually fade away, and somehow we'll get back to business as usual. But the great thing about investing in companies rather than economies is that you're able to find some great companies who are doing a good, iterative job to be able to deliver value back to shareholders. And we believe also very strongly in balance sheets and actually companies which are able to produce cash, real income, to be able to look after shareholders. And I think the Barclays Gilt Equity Study actually formulated that actually if you'd only invested for capital growth alone, you have actually seen pretty much a Zippo return over the last 30, 40, 10 years or whatever. It's dividend reinvestment that powers the engine of actually getting real money back to you. So that's a strong part of the heartland. But there it is, there's a little map. It's Scotland. It's up there on the northeast. My colleagues in Aberdeen believe it's a warm, almost Mediterranean climate up there. I think they just do that because I live and work in London, which is our biggest office with 900 staff. They say that the Gulf Stream licks around the top of the north of Scotland and keeps everybody warm when there are palm trees. Every time I go there, actually, it's hail and snow and rain. But I mean, they've got a great propaganda exercise for keeping the good head office doing it. This is our chief executive. He's the longest-serving chief executive of a FTSE 100 company. It's amazing. Martin Gilbert. He was one of 3 founding partners who really led the management buyout from Aberdeen in 1983. So 30-odd years ago, he and 2 others helped to set up the business, which was tiny. It had about 50 million of assets under management. And here we are today with sort of 330 billion of assets under management and have made it in 2012 into the FTSE 100 of companies. That's quite a shell shock for a small, sort of familial-orientated organization because suddenly you're very public. The blue-collar pension funds own great chunks of your stock. They have very strong attitudes about governance and so forth, and we become a lot larger than we were. But it's quite important for Aberdeen in its position as a northern, slightly Presbyterian, challenger-orientated brand to defy convention and see if we can do things which are better and stronger for what we can do, as opposed to the complexity which got us all into trouble in 2008 and 2009. So one of the watchwords around Aberdeen is trying to keep things simple, which is a fairly sensible way to try to approach it, particularly in equities. And even in complex products, like we've all got an iPhone in our pocket today, notwithstanding the electronics being a rather complicated morass of financial or of engineering in some description, is actually to try and keep things basic and understandable is an important concept to try to understand, and I hope we're going to try and abide by it. But that's Martin on BBC Radio some months ago. A book I wanted to bring with you today, which I had a lot of fun talking about, Golden Rules of Equity Investing, which was originally sort of authored by Hugh Young. He's our sort of Benjamin Graham equivalent, which is sort of things to do when you're trying to invest, and we can get you copies of this book if you leave your name or want to dive around on YouTube. But the 10 Golden Rules of Equity Investing, we even have a cartoon animation format, which is sort of an entertaining way to try to look at the do's and don'ts of when you're investing in stocks. It was actually narrated last year by John Cleese, who kindly agreed to tell the story for us, and it's a sort of whimsical approach about what is the type of way that we invest and what do we look at. And I think the thesis is, hence the small tortoise on the lower right-hand side, which is like, don't try and be the hare and constantly trade on every opportunity that could be moving your way. And forgive me if that's going to be a shibboleth to the short-term traders amongst you, but according to my analysis, most people are looking after retirement assets when they're running portfolios, not necessarily trying to trade deal to deal, or if they are, it's a very small bit of the pie that they're trying to do that to. Try to think long-term and stick to one's guns, even though when markets, Mr. Market is screaming at you to try and do something more perilous. So this sort of basic homily is nothing new to you experienced investors, but it's good to repeat that actually that's how our fund managers in equity business look after investing money. So we want to try and keep it simple. Our equity managers do this the same wherever they may be based, whether it be in Sao Paulo or in Philadelphia, where we manage US equities, or in Singapore. We devolve our fund managers in situ to the ground in which they invest, because it's all about, well, we call it company visits, which is a terrible code word for basically meaning interrogating company management and finance directors to find out, are they doing what they say they do, and do we understand them? And that's the basis on how we look after active equity investing. We need to go and kick the tires, interrogate the management, and come back and do it twice a year, even once we've got them into our pool. And like the John West salmon commercial, it's the ones that John West rejects and makes John West salmon the best. But the idea is that if there are thousands and thousands of listed companies out there, actually only a few hundred make it through the screening system, which is really what we call quality, and then try to make sure we're buying at a time when we're not actually mispriced relative to the market. And that's not a dissimilar to other areas, but it's actually one which takes a lot of time and due diligence and intelligence. It also means, I suppose, that we've got to believe that the fundamental investing still has a role when the game, and go back to where the central banks are trying to find interesting ways to disrupt our standardized models, and we have to try and live through those times and actually take it on the chin during periods when it can be difficult, because good times will come back for companies at the company level. And I mentioned we've been doing some work on researching what is it, the information that private investors want. And online, this is a study done by an outfit called Dionomy, which is a lead generation entity which looks at what private investors do. We ask questions on surveys. Where are you getting your information? And one thing that quite surprised me, because suddenly the talk in the city, it's sort of internet Mark II, is that everything is to do with digital. Whilst everyone wants to get access to financial websites and other information, actually there's still quite a strong core of older investors who are using traditional magazines and investment titles to be able to try and get the sorts of information they want to in order to guide them in the decision-making that they're doing. So this is just a chart to actually try to say, whilst 3/4 are using financial websites to try and get information, there's a whole wealth of other media which is open to people to try and determine their investment and stock selection processes. Listing the ones which are sort of valid third-party sites that people used, particularly to compare investment companies against the other. TrustNet was the old, most established website for looking to do comparative analytics against other investment trust companies, and it still remains a very good one. Morningstar bought a company called Fundamental Data 3 or 4 years ago, and they actually have quite detailed individual investment company websites, but actually generally the range of these are the options that people are able to look at for trying to make a decision about what type of stocks and what type of investment trusts they should be exploring, including ours. There were one or two points which were ignored by the people who work in the digital teams of our media agency, is that they're very keen to tell me what everything's new, exciting and digital and modern, whatever it was. Quite a large core of people still prefer to receive traditional information, including getting their statements sent to them by post. And whilst we're trying to accommodate the journeys of all our investors, wherever they may be, we think it's beholden on us to try to deliver what is wanted in a format, whether it be offline or online, in a way that's going to make it easy to report. So that was also quite surprising that investment trust investors, they're sometimes described as hobbyists, actually are very much self-reliant in terms of the type of investment advice they wished not to receive. Is a lot of them are running their own portfolios, and I hope and imagine a lot of people here today are actually self-directed and want to try and figure out what their own portfolios are, rather than rely on someone else losing them lots of money for them. The great shift now that's been going to direct platforms over the last 4 or 5 years have been from people saying, I'd sooner lose my own money if I have to lose the money, but I'd sooner try and understand what I'm investing in, because if I do understand what I'm investing in, at least I'm going to make my own call. And I think there's a big growth, partly driven by the regulatory changes, but actually mainly driven by access to intelligence and information on the web. So well done for AJ Bell, also encouraging to be able to get people looking at it, the digital enhancements and tools that weren't there before. We asked what magazines tended to be popular. A lot of the traditional ones are still there. There are monthly magazines like Money Observer and Investors Chronicle still offer people a lot of information when they want to have it, but these are sort of minority, but it's still part of the overall places where private investors tend to go to receive information about their funds. The short advertisement slide is the range of 17 investment trusts that we manage. We're probably most well known for our Asia-Pac investment companies. We've seen quite a lot of emergencies on a regional level of trying to find income funds. So whilst there are a lot of UK-orientated investment trusts, Merchants is not dissimilar. We've got a Murray Income, which is a UK equity income investment trust, but we also have assets which are deriving their income from overseas. And if one is looking to try to internationalize or globalize portfolios, which seems to make sense, although there are actually 70% of revenues may be coming from international companies listed in London, actually, if you want pure exposure to some of the fast-growing middle-class economies that are coming out of emerging markets and elsewhere, sometimes having a look at where you can diversify your portfolio risk internationally might be a way to try to examine where that the future may come from. Mr. Bogle, who runs Vanguard, I know I've got the wrong one actually, no, he index tracking funds, would actually say everything can be looked after by putting your money in an ETF, and that works very well in the US, where it's very hard to outperform the S&P 500. But the more you move to other, particularly emerging markets, you find that actually the index itself is one which is actually generally dragged down by, particularly in emerging markets, by commodity or oil-producing companies, which may be the yesteryear's story. They're just large capitalized instruments, and you may want to take advantage of actually having an active management style to give you exposure to those stock markets, which are more difficult to get access from, but also have the fantastic undiluted raw potential from investment returns from that particular territory. And actually, Hugh manages very well. He often finds listed companies of multinationals, so Unilever, Indonesia, for example, which you're just getting raw Indonesian soap sales coming through to you without actually having to carry the rest of the baggage of Indonesia's somewhat diluted portfolio across all the developed market stocks that you've got out there. So it's a slight pitch for diversification, but equally, the range of equity managers that we have are actually not just overseas, but we have a strong proportion of them are based in the UK, and our global equity team, which buys from a buy list of only the regionally approved individual stocks from the regions, you get the distillation of the best companies our teams can find from around the world. I wanted to say thank you very much for supporting us. This survey told us, I would show this one, is that actually where we are quite well liked as investment trust managers. Actually, the pack are quite closely tied to one another. Invesco and Fidelity and Henderson's are actually amongst the groups of those which people tend to own investment trusts from many different managers. Actually, the great thing about investment trusts generally is that there are only about 340, 350 companies out there, and it's a definable universe to go and explore in, and often they are managed by managers who might be hard to reach in the open-ended equivalent, or they've actually got some structural differences which make them an attractive option to explore. And certainly the boards try to make sure that the reporting, although increasingly reporting gets pages and pages of boilerplate, which I'm afraid is a regulatory condition rather than one that is talking about the fund, but we can talk about electricity consumption and other interesting elements which are being included in the board reporting. But actually, it's a great little sector for people who want to spend the time exploring where it is that they want to invest. And we think that the reporting, to some extent, in investment companies is greater than you would find out of a vanilla open-ended fund. And typically, if nothing happens on an open-ended fund, it can just lie there dormant with not doing a great amount. In investment trusts, eventually, if it's underperforming or things aren't going well, the shareholders will kick up and actually ask for some corporate action or something to change, or the manager to change, which I think is an encouraging discipline for the fund manager to try to see that it's performing as well as it can for clients. I probably don't need to sing on too much about what an investment trust really is all about. We've got some characteristics which are slightly different. It's important to be attentive to when things fall out of favor. The discount to premium is a subject of much sophistry and discussions, but over the longer term, it probably means less important than people want it to be. You own the share rather than the NAV. If the price is very much discounted, you've got to look at the reasons why. Is it to do with a seasonal disaffection for the subsector, or is it there's something fundamentally wrong with the company, or is it a stonking bargain? From the board's point of view, people who trade these stocks just purely on price anomalies can add to volatility. So the type of shareholders that the board is looking for are generally those who are wanting to buy retirement assets for the longer term and buy and hold. They reduce the volatility of the price. And that's often why the private investors are sought after rather than trying to find short-term arbitrageurs or value investors to disrupt the nature of the business. So if you go to a board meeting, it's always good to ask them, do they have strategies to either make sure that the capital structure is being managed as well as the NAV? You have to manage the structure of an investment trust, which is great when you're dealing with a downturn. You can generally get a price for selling the stock, and if you ever get caught in an open-ended fund in a massive downturn, and some of you may remember there's a big property fund about 20 years ago, it was a retail fund, it owned physical assets. When the unit holders then flog it all at the same time, they either have to close the fund for a period of time, and they can't actually fulfill all the cash that's been trying to exit from the particular company. Generally, as listed companies, closed-end funds, you will get a price, even though it may not be the most favorable one on the day, if you need to get out. And liquidity, and that's an attractive issue, of investment trusts are important. If the trusts are very, very small, they may be more illiquid, and it's one of the things worth looking at about the size of the companies that we're looking after. I've now been warned out that we're out of time. Before winding you through the different pieces around the other characteristics of trusts, I was going to put my tortoise again to keep you on the toes and a bit of detail about how we manage money and where it comes from. I quite like Citywire is another interesting newswire service which covers investment trusts, and if you go browsing through their sort of educational guide, if those of you are more interested in knowing more about it, we sponsored a guide that was put together by some of the sell-side analysts and some of the buy-side analysts about looking about what investment trusts are all about. And I'd like to thank you very much, as I've run out of time, for giving me the moment to talk to you about where you might be looking and why we might be worth looking at as well. And there's an Aberdeen taxi. We're not running the campaign at the moment with the cabs. The brand team of having to cut back in these austere times, but it will be back next year, I hope, when things get better. Thank you.